I'm Tom Sosnoff. I've been trading options for more than 4 decades, and I share my trading insights with traders of every skill level daily on the tastylive network. After speaking with hundreds of thousands of traders, I've found one thing that all option traders have in common. They want to take their trading to the next level. In this video, I've gathered 6 of the smartest quants I know, and they want to share their intermediate and advanced trading techniques with you. So strap in. If you're serious about trading, it's time to get serious.
Of this group of geeks, I can say that I probably know Dr. Jim the best. I've had the pleasure of traveling and speaking with him for the past few years. He is, in my opinion, the best speaker I know. Don't tell Tom Sosnoff. He hosts a live show on the network called From Theory to Practice. And as a former professor, he is the most qualified person I know to take these complex things and break them down. The reason that I am being so nice is that he can squat 445 pounds, bench 305, and deadlift 445. On tour, he sometimes gets pegged as our bodyguard. He loves his family, he loves his fitness, and he loves finance. Please give it up for my friend, Dr. Jim Shultz, with his presentation of the things you didn't know about selling options that isn't related to time or volatility.
So you think you know all there is to know about selling premium. You don't. Like you think it's all about positive theta. It isn't. Like you think it's all about overstated volatility. It isn't. Like you probably think, man, if I just keep this simple and just do the opposite of whatever Tom does, man, I'm going to be all set. Well, that is certainly a rock solid strategy. That's not it either. What we're going to talk about today isn't related to time, volatility, or Tom's trades. What we're going to talk about today is entirely related to statistical distributions and gimmies and gotchas, as it should be. And what we're going to discover is going to completely change the way that you view trading in general or selling options specifically. And so when you think about premium selling, right, what is our big risk? What are we most exposed to? As premium sellers, we already benefit from the passage of time, so that's not it. We already benefit from market volatility's tendency to contract, so that's not it. The big risk when it comes to premium selling is always going to be the big outlier move. The big, huge, extreme move against you. That's going to be the big gotcha. Now, if you've seen my show, if you've watched our content, then you know for every gimme, there's a gotcha. So you might be thinking, Jim, if there's a pretty big gotcha, then there must be a pretty big gimme somewhere too. Well, there is. And this gimme might totally change the way that you view the markets. A gimme that's not related to the normal distribution. The same normal distribution that we know and love and base all of our return projections on. A gimme that isn't related to the log normal distribution. The same log normal distribution that is inherent to the stock market, that caps the risk to the downside at 0 but opens you up to infinity on the upside. It's not that one either. This is a gimme that is related to an altogether different distribution. A distribution that is no less real than the normal or the log normal, but is uniquely positioned to favor premium sellers in a very, very special way. The Leptokurtic distribution. Now, with a Leptokurtic distribution, there are 2 characteristics that we want to be familiar with that are distinctly different from a normal distribution. One of which is our hero today, the gimme, the other of which is our villain today, the gotcha. Well, let's start with the gotcha first, because you might already be familiar with this if you've ever read Nassim Taleb's work, Fooled by Randomness, Black Swans. You've already heard of this term before. You might already be somewhat familiar with this idea of the extreme outlier move and just how prevalent it is in the market. When you have a Leptokurtic distribution, what you end up with in the marketplace is the tails of the distribution are fatter than they would be in a normal distribution. The tails of the distribution, the extreme observations, the big outlier moves, the 2 standard deviation, the 3 standard deviation, the 5 standard deviation, those observations are going to occur more frequently than you would expect in a normal distribution. This is the first characteristic of a leptokurtic distribution, and this is the one that you might already be familiar with. The formal term of this, of course, is positive kurtosis. And positive kurtosis characterizes a leptokurtic distribution in a familiar way with these extreme observations. Like, for example, let's take a look at a few of our favorite premium selling strategies, starting with the short put. Now, many traders believe that the short put is one of the best premium selling strategies out there, if for no other reason than it is so simple. Well, with a short put, you are in a situation where you're taking advantage of time passing, positive theta, volatility contracting, negative vega, and also the positive drift that is inherent to the stock market. So you have all of these things working for you. But where's your risk? It's to a move to the downside. Well, where is your big risk? A big move to the downside. What about a ratio spread? Like maybe a call ratio spread for all my naked call sellers in the house, which there may not be many, but there could be a couple stragglers out there. You've got a call ratio spread. What do you have working for you? Well, if the market drops, you've got the credit that you've collected that's covering you, so that's going to be a profitable outcome for you. And hey, even if the market rallies, it might rally right into your long call spread, so you could make even more money in that scenario. But where's your risk? To a move higher, to the upside. Where's your big risk? To a big move higher, to a big move to the upside. All right. What about a short strangle? The classic, plain vanilla, Betty Crocker strategy that we all know and love, the short strangle. All the benefits of selling premium, but now you get them not one time, but 2 times, because you're selling both sides of the market. So that's obviously beneficial. That's obviously advantageous. But where is your risk now? Both sides of the market. To the upside and to the downside. Where's your big risk now? Both sides of the market. To a big move to the upside and a big move to the downside. So maybe it's not so great. When you sell premium, like a short put, a ratio spread, a short strangle, you are going to be exposed to the 2, 3, 5 standard deviation moves. This is what you are up against, and this is what you're going to have to absorb. When you have to contend with a leptokurtic distribution, then you are going to have to be okay with living in those extreme observations more regularly than you would anticipate with a normal distribution. But that's only half the story. When you have a leptokurtic distribution, yes, you've got the black swans, you've got the fat tails, and they get all the press, they get all the glitz and the glamour, and rightfully so. Because man, you catch a 4 standard deviation move on a stock when you're holding a short put, woo baby, that is going to soil just about anyone's underoos. But the fat tails are not the only thing that's happening inside of a leptokurtic distribution. Not at all. You also have a greater peak in the center of the distribution. You have a peaked mean that extends higher than what you see in a normal distribution. Now, what does this mean to us as premium sellers? It's very simple. You are going to observe more observations in the tails, more observations on the extremes, more observations with these outlier moves, but you are also going to observe more observations right around where the market is, more observations right around the mean of the distribution, which is a perfect outcome for a premium seller. Doesn't matter what you do. Short put, ratio spread, short strangle, jade lizard, spiked lizard, whatever it might be, anything from the lizard family works. The tighter clustering of the observations right around the mean is going to be extremely advantageous for you as a premium seller. So when you move from statistics to markets, i.e. from theory to practice, what you're going to find is the statistical mean that you find in all of these different distributions, whether it be a normal, whether it be a log normal, whether it be a leptokurtic, whether it be chi-squared, whether it be Poisson, whatever it might be, the theoretical mean that is in those distributions translates to the practical price that you find in the marketplace. And so when you move from theory over to practice, we can now use these results to help us become better traders. Because in a leptokurtic world, what you're going to find is the observations around the mean are going to be more frequent. They're going to be more prevalent than the observations away from the mean. So with the power of short premium, is it the passage of time? It is. With the power of short premium, is it overstated volatility? It is. With the power of short premium, is it all of the consistent, reliable, empirical results that the team has found all these years over and over and over again? It is. But lying just below the surface, governing all of that, is this leptokurtic distribution that the market has exhibited over the years, that are driving these results, that are helping us realize more observations around the current price, that's making it so advantageous to sell premium and assume the short side of the options contract. And so, by selling premium, you are able to take advantage of the simple passage of time along with contracting market volatility. We already know that. But it is the big outlier move that poses the greatest risk to almost every premium selling strategy. However, while the underlying leptokurtic distribution in the market can increase the number of these outlier moves, it can also increase the number of the small, uneventful moves. And so in the end, as it turns out, all those black swans, they may not be so bad after all. Thank you.
TP, Tom Preston, is tastylive's chief market strategist and has been with us since its inception. Little known facts about TP. He majored in the classics, Latin and Greek. Who knew? He loves to trade the bonds because they are big, they are liquid, and they scare the children. And just to share with you how unique TP is, when I asked him what he would spend $1,000 on, just himself, not trading, not his family, his answer? A baby buffalo calf. He is the one who taught Jenny and I how to find a one standard deviation option in under a second. He is our volatility expert. And my favorite saying that he uses, hedge, is a 4-letter word. He's also the man, the myth, and the legend behind 4 of the 5 cherry bombs that come directly into your inbox. Now buckle up for our next presenter, TP, with his don't fight the normal distribution, use it to your advantage instead.
Don't fight the normal distribution. Use it to your advantage instead. When we say that stocks and other assets are standard normal variables, what does that even mean? It means that oftentimes price changes are random, can be random, and that the probabilities of price events can be quantified. And the importance about that is that it makes decisions about trading strategies easier. It takes the burden off you as a trader. It makes finding trades simpler. So the question is then, are stocks standard normal variables? Are price changes randomly distributed? Here's what I did. I took 5 stocks. 5 stocks from a list. I didn't cherry pick them. I didn't know that the data was going to be a certain way before I started. I just pulled 5 stocks from different industries, different volatilities. I didn't care. Just pull 5 stocks. Went from 2010 to 2024. Why 14 years? I don't know. It's a long enough time. Covers different market conditions. And I calculated 60-day returns. In other words, day 1 through day 60, what was the percent price change? Why 60? Well, sometimes we base our trading decisions based on 60 days expiration, but really the same price behavior that we see with 60 days is the same as we see with, let's say, 10 days, 20 days, 80 days. It really doesn't matter. The question is, are they normally distributed? Here are the 5 stocks, and here's the data that I found. So here's Amazon. What do you see with this graph? Amazon is mostly, well, the graph itself is a histogram of the percent price changes. That's what the blue data is. And the black curve on there is a normal distribution curve based on the volatility of those price changes. So what you see here are right in the middle, where the top of the bell curve is, that normal distribution curve is, you see more price changes than the normal curve would predict. The same is true on the left-hand side, the downside. That means there are bigger price changes, negative price changes, than the normal curve predicts. That's Amazon. Let's go to NVIDIA. Different stock, different volatility. Same thing. You see more small percent price changes in the middle of that curve than the normal curve predicts, and you see on the wings more data points than the normal curve presents. So it's kind of normal, but not perfectly normal. Let's go to Merck, the drug company. Same thing, right? Same thing. I have more small percent changes than the normal curve predicts, and I have larger events of large percent changes than the normal curve predicts. Okay, so it violates both in the middle and on the wings. And finally, Starbucks, well, no, not finally, this is number 4. Starbucks, again, same behavior. More small price changes than the normal curve predicts, and larger price changes than the normal curve predicts. GM, same thing. So regardless of the stock, regardless of the industry, the fundamental volatility, it doesn't matter. They all exhibit, these 5 stocks anyway, exhibit roughly the same types of price behavior. So what does this mean? Does it mean they're not normal? Well, let's ask a question. Instead of me eyeballing this, what I did was I took an actual statistical test. The Shapiro-Wilk test is a test for normality. It's been around for, 60 years. It's a standard test. There are lots of others, but this is an easy one to calculate and pretty straightforward. And what this does is say, okay, I'm going to set a p-value. And as long as the p-value, the results, are greater than 0.05, then I will not reject the hypothesis that the data is normally distributed. So what this Shapiro-Wilk test does is say, if these large changes on the wings, if they actually happened, in other words, if the data were normally distributed, what's the likelihood that they would actually occur? And so what you want is to see a large Shapiro-Wilk value. You want p above 0.05, like 0.10, 0.20, that sort of thing. But what do we see? Amazon, the p-value is 3.14 times e to the negative 24. That's really, really small. NVIDIA, e to the negative 17. Merck, e to the 05. SBOX, Starbucks, e to the negative 20. These are tiny numbers. Shapiro-Wilk says these are not normally distributed. Okay, fine, but so we reject the hypothesis that these stocks price changes are normally distributed. Let's take one step further. Let's look at kurtosis. And kurtosis, by the way, if we go back to these graphs, kurtosis is the idea that the data is either more tightly bunched up than the normal curve predicts, or more spread out than the normal curve predicts. Okay, so the standard normal distribution would have a kurtosis of 0. Let's say, and there are different ways of scaling it, but the way I look at it is I just scale it towards 0. That's one typical way to scale the kurtosis. So it's a measure of how often outliers in the far right or far left tails of the distribution occur. Stocks often have larger price changes more frequently than the normal distribution predicts. It is leptokurtic. So Again, let's see how leptokurtic this stuff is. Kurtosis is 0 for something that is perfectly normally distributed. Okay, kurtosis above 0 in this case indicates fat or tails. So what do we see? Amazon has a kurtosis 74, Nvidia 60, Merck 30, Starbucks 57, and GM is 99. This isn't sky-high leptokurtic. Okay, so yes, big price changes occur more frequently than the normal distribution suggests, but not extremely so. And if we go back and look at those graphs again, the normal curve does a pretty good job at defining what the characteristics are. And why is that important? Well, the normal curve itself has been around for about 200 years. It is mathematically very well established. It's also very fast to calculate. And if we're talking about technology and trading, the ability to run these calculations in milliseconds is vital, because you want to take that live market data, derive the probability data from that normal curve, and spit it out in real time. The calculation for the normal distribution is very, very fast, very, very efficient. So if the stock price data, even though it's not perfectly normally distributed, if it's close enough, we can rely on that calculation to turn stocks into standard normal variables. What is a standard normal variable? It has a mean of 0 and a standard deviation of 1. What does that mean? Well, stocks, stock prices themselves are log normally distributed. But stock price changes, and that's what we looked at in those charts and graphs, are normally distributed. That's the argument. And we standardize them by a certain process to give them a mean of 0 and a standard deviation of 1. That is a standard normal variable. Why is that important? Because it lets us place stock price events on the normal curve and quantify the probabilities. To actually do that, to turn any data point into a standard normal variable, you subtract off the mean of the data set and divide by the standard deviation of the data set. That gives you mean of 0 and standard deviation of 1. We use Black-Scholes and the genius of Black-Scholes to do that for us. So that's what the core of the Black-Scholes model does. And I know some people poo-poo Black-Scholes. Oh, it doesn't work, right? It doesn't tell you where the stock is going to go. It doesn't give you any. No kidding. I get that. It's not supposed to. Okay. With the genius of Black-Scholes is that it doesn't depend on anyone's opinion of whether a stock is going to go up or down or nowhere. It doesn't care. Okay. It doesn't care what the debt ratio is, the PE ratio. It doesn't care. All it cares about is how far away the strike price is from the current stock price in percent terms. So what Black-Scholes does, the genius, is that they turn Fisher Black and Myron Schultz, Fisher Black and Myron Schultz turned the stock price change into a standard normal variable. How? Up on the top, formula, C equals ND1 times stock price minus ND2 times the strike price, raised times E, raised to the negative RT, yada, yada, yada. That's how you price a call, according to Black-Scholes. But the key, the core of Black-Scholes, the important piece of Black-Scholes, is in D2. That little chunk in there. And what that is, it's the natural log of the stock price divided by the strike price plus interest rates minus the volatility squared divided by 2 times T divided by volatility times the square root of time. That's what T is. Huh? Okay, let's look at this in detail. What's happening here? Ln times S over K tells me how far in percent terms a stock is from the strike price. in continuous returns. So it's not a one big jump, not up 5% just in one big thing. It can be these little incremental increases or decreases, and that's what the ln, the natural log, gives you. So what that is doing is creating an idea of, we're basically subtracting off the return, the potential return, and we're seeing how far that strike price is away from 0% return. If we skip past the r minus sigma squared over 2 times t, what are we doing? We are dividing by sigma, volatility, times the square root of time. So the top part, the ln of s over k, subtracts off the mean and gives us a mean of 0. For the standard normal variable, the mean is 0. And if we divide by sigma times the square root of t, we're dividing by volatility, it turns it into a standard deviation of 1. So the genius of Black-Scholes in this D2 mess of a formula is to turn stock prices into standard normal variables. And it is from this that we derive our probabilities that make trading decisions simpler. So people argue about Black-Scholes. The 2 complaints about Black-Scholes is that it doesn't capture those Leptokurtic events. It doesn't price that in. And there's a solution to that. The second point is that it's not, it requires different volatilities. Okay, there's one volatility input, so Black-Scholes doesn't price every single option on an option chain with a single volatility. That's part of the complaint. But here's the problem with some of the improvements to Black-Scholes or the other models. Black-Scholes uses data that is easily observable in the marketplace. So I know the strike price, I know the stock price, I know time to expiration, I can find an interest rate, I can put in a volatility input, and I can get that answer. To improve on Black-Scholes, and I've looked at every option pricing model out there, they require other inputs that are not directly observable. So I may need to come up with another formula to estimate what some parameter is. That makes it hard to calculate. It makes it not transparent. That's why Black-Scholes is the core for every, the assumptions that Black-Scholes make, that a stock price change is a standard normal variable, underlies every other, or just about every other, option pricing model out there. That's why it's so important. The way Black-Scholes handles these Leptokurtic events, and the way the probabilities from Black-Scholes, that D2, the way the probabilities handle those Leptokurtic events is volatility skew. The IV skew, implied volatility skew, is the behavior, the fact that we see different implied volatilities at different strike prices. You've seen that on trading platforms. It's relatively easy to see. Out-of-the-money puts and equities typically have progressively higher implied volatilities. Out-of-the-money calls have progressively lower volatilities. Typical behavior, and skew was born, the rumor is, and this is pretty accurate actually, skew was born in 1987, before which they were still pricing all the options on the CBOE with a single volatility. And the crash showed them that bigger price changes were possible that they never anticipated. So let's skew these options. But one of the keys is the growth in technology that accompanied the growth in trading. That the ability for computers to calculate these numbers, to go through this normal distribution stuff in milliseconds, made this so much more accessible to regular traders everywhere. Professional traders, sure, they might have had it earlier, but the computing power that's required to do this quickly in real time grew right along with this knowledge. So, what's important? The fact is that there is no component of an option pricing model, none whatsoever, for a bullish or bearish bias. The model doesn't care. In trading, we handle kurtosis with defined risk trades and handle the non-normality by basing trades on probability. So that skew that points to where the risk is, remember, IV skew doesn't say that's where the stock is going. It just says that's where the market thinks the risk is. So that implied volatility calculates the probability that the stock will actually reach that out of the money call or out of the money put. You pick the probability you want, and accept the risk of that trade. That's what it is. So you use the skewed probabilities. They solve that kurtosis and non-normality for you. Okay? The market solves that problem. Now, there are a couple of points. When I say use the normal distribution, you will not escape the normal distribution. You won't. It's too big. Okay? So what do? Don't confuse being right on duration with being right on direction. You may find that if you have enough capital, you can hold on to a losing trade indefinitely, and maybe at some point in the future, it becomes a scratch or a winning trade. Maybe, right? But the point is, does that mean your stock picking ability was so great? Oh yeah, it went up finally. No, that doesn't necessarily mean that. It means that over time, the normal distribution just dragged that stock price back up again. It doesn't mean that your direction picking is good, if at all. It just means that you had enough capital to hold on to the position. So the point is that no matter how you derive your bullish or bearish bias, okay? I don't care whether you use a chart, technical analysis, fundamental analysis, I don't care. Use a probability-based strategy. So put the probabilities on your side. And we are relying on the Black-Scholes model and the normal distribution and the fact that stock returns exhibit standard normal behavior to calculate those probabilities. If you can accept that asset prices, stocks, bonds, anything, are standard normal variables, like I said, it frees you from all the work of having to be right on direction all the time. It lets you put the probabilities in your favor. So does it mean you're always going to make money using them? No, that's not what it means at all. It just means the odds are in your favor with a particular trade, and that you don't have to be right on direction all the time. Thank you.
Ryan Grace, our head of global digital assets, is the newest addition to Geeks on Tour this year. And boy, am I glad he's here. He does, in fact, consider himself a geek, ironically, although he does not look the part. And when he is not climbing mountains, he is talking crypto. This guy eats, sleeps, and breathes the crypto markets. You're gonna all wanna get a pen and paper out for this one. Ryan Grace talking decentralized exchange. The future of trading is on the blockchain.
Hello, my name is Ryan Grace, and today I want to talk about the concept of decentralized exchange, which very well could be the future of trading. What is a decentralized exchange? Well, decentralized exchange is a blockchain-based exchange where users can trade cryptocurrencies directly from their wallet without an intermediary. There's no centralized exchange, and there's no broker. In effect, you're actually kind of your own broker. So what makes an exchange decentralized? Well, there's 4 important pieces to this. The first is that it's non-custodial. This means that instead of a brokerage account, you connect your crypto wallet and you retain control over your funds the entire time that you interact with the exchange. It's also trustless. There's no brokerage account, again, so there's no intermediary or counterparty that you need to trust. You simply only need to trust the technology. It's permissionless. A decentralized exchange is available to anyone, in theory, with an internet connection. Anyone can access the decentralized exchange to trade tokens, assuming there's liquidity available to process the transaction. And it's completely transparent. All transactions are recorded and settled on a blockchain, making them publicly accessible and verifiable by anyone at any time. But maybe to better understand the differences between centralized and decentralized exchanges, let's compare the two. With a centralized exchange, there's a central authority that oversees and facilitates trading between buyers and sellers. You can think about this as the NASDAQ, the New York Stock Exchange, Chicago Mercantile Exchange. These exchanges require intermediaries, such as brokers and clearinghouses, to conduct and settle trades. And trades are filled using an order book, where buy and sell orders are matched by price and time priority. It also requires a brokerage account, and transactions are recorded and regulated by the central exchange. Fees are paid to these intermediaries that operate on the exchange, and there's central oversight and security. Central exchanges are regulated. On the other hand, here are the differences with a decentralized exchange. On a decentralized exchange, or DEX, users trade directly with each other. There is no central authority. There's a protocol on a blockchain, but there's no New York Stock Exchange. And there's no intermediaries either. Trades are executed between users using something called an automated market maker. And trades are filled using liquidity pools, and prices are determined by algorithms based on the ratio of tokens in a pool. And instead of a brokerage account, decentralized exchange requires a crypto wallet. Transactions are recorded on a blockchain, and fees are paid directly to what are called liquidity providers. We'll talk about this in a little bit. Centralized exchanges and decentralized exchanges have positives and negatives, pros and cons to them, but a decentralized exchange is transparent, cryptographically secure, and users are responsible for their own security. So let's take a look at how a decentralized exchange works. The exchange is replaced by a blockchain protocol that lets people trade tokens directly without an intermediary. So instead of a bunch of brokers, market makers, and clearing firms, decentralized exchange happens through smart contracts, which is simply just code, automated market makers, an algorithm, and liquidity pools. And all trades on a decentralized exchange, they settle transparently on a blockchain. Users connect to the protocol or the decentralized exchange by connecting their crypto wallet and then interacting with these smart contracts, which facilitate the entire process. In some ways, this is very similar to logging into your brokerage account and interacting with the brokerage platform that facilitates your trades. Let's take a look at these pieces in a bit more detail. Let's start with liquidity pools. Where does liquidity on a decentralized exchange come from? Well, in short, it comes from the users of the exchange. Instead of traditional market makers providing liquidity to an exchange by posting prices that they're willing to buy and sell at, liquidity on a decentralized exchange comes from what are known as pools. Pools are groups of tokens that users can interact with by trading one token for another directly from the pool. Liquidity in these pools is provided by users depositing tokens into the pool. As an incentive for providing liquidity, users that deposit tokens to facilitate trading receive a portion of the trading fees charged by the exchange in proportion to their share of the pool. So compared to centralized exchange, and let's say a user paying a commission fee to a brokerage to facilitate the order, and many intermediaries that are in between, all of the fees that are paid go directly to those that are providing liquidity to facilitate the transaction. So liquidity comes from liquidity pools. Let's take a look at an example of how a liquidity pool works in more detail. So when users come to a decentralized exchange, they can interact with the exchange by swapping tokens or providing liquidity. To provide liquidity, it's very simple. Users simply deposit two different cryptocurrencies in the pool. Here, we have an example where a user is depositing USDC, the US dollar stablecoin, and Ethereum, a cryptocurrency, in a liquidity pool. From there, the user needs to define the price range where they'll provide liquidity. The decentralized exchange charges a fee when any trader swaps tokens and trades occur within this price range. Users providing liquidity then receive a share of the fees that are paid by these traders. And liquidity providers can collect their fees or add or remove their liquidity at any time. And in some cases, it can be a quite lucrative activity to provide liquidity to decentralized exchanges, given the yield is generated from those fees that traders swapping tokens on the exchange are paying. Let's now talk about another very important component to decentralized exchange, which is the automated market maker. There are no high-frequency trading firms. There are no typical or traditional liquidity providers or aggregators, which are used in finance today. Instead, we have algorithms. Liquidity is sourced from pools. Prices are set by an algorithm called an automated market maker. The automated market maker sets the price of each token in a pool using what's called a constant product formula. This is X times Y equals K, where X and Y represent the quantity of the two tokens in the pool, and K is a constant. When someone wants to trade one token for another, the automated market maker calculates the amount of the token they will receive using this formula based on the current balance of tokens that make up the pool. Once the trade occurs, the pool balances are adjusted and the prices of each token in the pool update accordingly. This is how orders are filled on the decentralized exchange. Here's an example of what this might look like. Again, X is the amount of one token in the liquidity pool, Y is the amount of the other token in the liquidity pool, and K is a constant. This is how we get to those prices and balances of tokens after trades occur in each pool. Finally, all of this is facilitated by what are called smart contracts. Smart contracts are programs that execute automatically with terms of agreement written directly into the code. When predefined conditions are met, the code automatically enforces and executes the terms of the contract. This replaces many of the traditional intermediaries. Instead, users interact directly with code. Here's an example of what this looks like. Let's say that we want to automate the sale of thousands of tokens at a specified price. That can be written directly into the smart contract and automatically facilitated when someone interacts with the contract. Why does any of this matter today? Why do we think it could be the future of trading? Well, if our view is that the world is becoming more and more digital, how we live our lives, how we interact with one another, decentralized exchange creates a financial layer for this world. In a digitally native world where assets are represented on-chain in tokenized form, decentralized exchange protocols are the infrastructure for seamless exchange across these markets. In theory, liquidity pools can exist for any tokenized asset and operate continuously across blockchain networks. Access is permissionless, and users maintain control over their assets at all times. As a result, this is a system that requires less intermediation and is ultimately more efficient and certainly more transparent. I like to think of it as the financial layer of the internet, where liquidity exists for decentralized applications in all forms of digital assets, much like the financial system we have today, where liquidity exists for commerce and trade in a more physical world. But is it actually the future? Well, I would say it's still very early. There are clear signs of growth. Many decentralized exchanges have only been around for a few years, though. When you look at whether people are actually using these exchanges, are they trading, total decentralized exchange volume has grown meaningfully over time, with about $22 billion in capital that's currently providing liquidity in these pools to facilitate exchange on-chain. It's a lot, but in the grand scheme of things, it's also a little relative to where we are today. Decentralized exchange volume is only about 8% of centralized crypto trading volume, but it has been as high as 15% over the last year, and I would expect that it grows over time. When we look at specific exchanges for context, the daily volume of one of the biggest decentralized exchanges, Uniswap, is roughly half of the daily volume experienced by one of the biggest centralized exchanges, being Coinbase. So again, it's still fairly early in the big picture. But why should we care? What's fascinating about decentralized exchange, as a user, it opens the door to a world of trading opportunities and possibilities, different ways that you can interact with the markets. We talked about liquidity pools at the very beginning. This is a role that in traditional finance, most users cannot play. In decentralized exchange, you can provide liquidity just as easily as you can swap tokens on-chain. This creates opportunities to generate yield, opportunities for new strategies, and ways to diversify your overall digital assets or crypto portfolio. It also enables the creation of liquidity pools for almost any asset. I don't think it's much of a stretch to envision a world where securities, such as Apple stock, are represented in tokenized form on-chain. Now, this doesn't mean that the existing system goes away, but it does lead to the creation or the evolution of an alternative system that I think is compelling to some people. And if you can tokenize securities such as Apple stock, you can custody that stock on your own, on-chain, using a crypto wallet, then again, it's not much of a stretch to think that you should be able to provide liquidity for Apple stock and, let's say, a US dollar token directly on-chain through decentralized exchange and generate yield, in many cases, paid in that same stock as a reward for providing liquidity. I think it's certainly possible that we see an increase in users participating on decentralized exchange on-chain as we move forward and this technology continues to evolve. Thanks again for watching. I'm Ryan Grace, and this has been the concept of decentralized exchange.
Julia Spina. Where do I begin with this one? First of all, she's not a geek. She has got swag, and everyone wants to be like her. She is, was, and always will be the smartest person in the room. You need a probability game for the live show? Call Julia. You need a complex equation done in 5 seconds flat? Call Julia. You want to launch a cutting-edge finance app that appeals to the younger generation? Call Julia. She's out of everyone's league. She is smart, she is funny, she is talented, and she's tall. She is a tastylive on-air personality and the CEO and creator of the Bad Trader app. And did I forget to mention that she's also the author of The Unlucky Investor's Guide to Options Trading? In my opinion, the best options trading book on the market. I'm 100% convinced that we will all be working for her one day. So get your helmet on for the presentation of market crashes and models to help you spot them.
Hi, everybody. So I find market crashes endlessly fascinating. I knew I wanted to talk about them today, and I went down a bit of a rabbit hole figuring out exactly what topic to cover. So today, what I wanted to talk about were models that may be able to help investors detect crashes in real time, which experienced investors can tell you can be very difficult to do. So in very rare cases, markets enter periods of extreme volatility, and those periods have notably different properties than other typical bullish market conditions. And they have, as rare as they may be, significant implications for investors, particularly with respect to risk. But they're not well understood because of how rarely they do happen. So the goal of this talk is to introduce the concept of volatility states, which the market may transition between, introduce one type of model that may be able to detect those transitions in real time, and share some insights into the research process. Okay, it starts, as many things do, with the Black-Scholes model. So the Black-Scholes model asserts that stock prices follow a geometric Brownian motion with constant drift and volatility. And what we can see here, this graphic, is a particle undergoing two-dimensional geometric Brownian motion. And when we look at the cumulative horizontal displacements from its starting point, we can see something that actually closely resembles a stock price, which is pretty cool. This simplifying assumption, which we mostly make for mathematical simplicity, gives us a very straightforward model for stock price dynamics, driven by this standard Brownian motion, WT. And a consequence of this is that log returns are assumed to be normally distributed. And this is an extremely important conclusion because it forms the basis for many of the probabilistic assumptions that traders use. Expected range, expected move, for example. So to test how well this model sort of holds up, this very simplifying assumption, we can use quantile plots. So quantile plots are an extremely useful statistical tool that compare two distributions by plotting slices of the distributions against each other. More specifically, quantile plots compare two distributions via their quantiles, or distribution slices that divide the distribution into equal probabilities. So for example, here are the 3 quantiles of the normal distribution. These are 3 slices that create 4 equally likely subdivisions of 25%. So when we use these plots for real returns data, we can use them to directly compare the daily log returns, which we're interested in testing in this case, against a benchmark distribution, which is going to be the normal distribution in our case. And what we really need to look for is that if these distributions are similar, then the data should follow a straight line. And that straight line would be 45 degrees if the distributions were identical. But here we're just really looking if log returns follow any normal distribution. So again, looking for that strong linear relationship to test this normality assumption. And so what we see, for example, from 2004 to early 2007, SPY's daily log returns actually very closely follow a normal distribution without obvious signs of fat tails. Again, seeing this very strong linear relationship for 3 years worth of data. But we see that SPY's returns begin to significantly deviate from this linear trend, this historic distribution, again, of 3 years leading into the 2008 crash. And what we're looking at here is a dynamic plot of the quantile-quantile relationship between SPY's log returns against a normal distribution. And we can see that as the market enters this period of extreme volatility, this linear relationship begins to break down, particularly at the tails, which is where our extreme moves are located. So our first observation when we look at this dynamic plot is that these extreme moves are significantly larger and more likely than what's estimated by SPY's historic distribution. So again, as we enter this extreme volatility state, the moves are significantly different than what SPY's 3 years of historical data estimated, which was fairly normal. When we measure stock data over a significant period of time, sufficiently long period of time, here SPY is an example, we see that stock log returns tend to exhibit significant kurtosis, or fat tails, which indicates a higher propensity for outlier moves than what is estimated by a normal distribution with the mean and standard deviation of SPY's log returns. Normally distributed random variables should exceed 3 sigma in 0.27% of occurrences, so very, very rarely. And what we see from SPY from 2004 to 2024 is that SPY's log returns exceeded 3 sigma 1.64% of the time. So overall, still pretty unlikely, but a lot more likely than what the normal distribution estimates. And here, sigma is just the standard deviation of historical returns, which is about a 3.6% move to the upside or downside for SPY. That's really what we're looking at here. Our second observation when we look at this quantile-quantile plot is that these extreme moves tend to occur within very close proximity of each other. They tend to sort of cluster together. So when you get one, you tend to get more in very short time frame relative to each other. So this is a concept that we call volatility clustering. It's that outlier moves not only tend to be more likely than what a normal distribution estimates, but rather they also occur within very close proximity to each other. So for example, SPY's daily log returns exceeded 3 sigma, about 3.6%, 1.64% of the time. So overall, again, very unlikely. But on any given day with a 3 sigma move, so a move larger than 3.6% to the upside or negative 3.6% to the downside, another 3 sigma move followed within 2 weeks, 74% of the time. So basically what that means is that if there's a 3 sigma move today, there was a 3/4 chance of having another one within 10 days, or roughly 2 weeks. 10 trading days is roughly 2 weeks. In fact, there were about 2.75 3 sigma moves that followed within two weeks of the first, pretty much. So again, this volatility clustering, when we have one very large move, there's actually a pretty high likelihood of having another one within a very short period of time. And these observations that we've made with respect to these quantile-quantile plots, when we're looking at real data, is that the market may in fact shift between volatility states, where each volatility state has unique properties and tends to propagate for a sustained period of time. And this observed market phenomena, which we observe across many assets, not just the S&P 500, is not really captured by the simple model for price dynamics asserted by Black-Scholes. And even the most experienced traders have difficulty navigating these shifts, specifically a shift from a low volatility regime to a high volatility regime. That's for several reasons, but the first of which is that they come on very suddenly and they impact nearly all sectors. So here we're looking at the rolling 30-day correlation between SPY and a couple different sector ETFs. And we can see as the market starts to sell off really steeply in 2020, that the correlation between SPY and these different sectors becomes stronger and stronger. They all experience concurrent volatility, at least the assets that we were looking at. These events are also incredibly rare, which limits the reliability of quantitative analysis. If we're trying to understand the characteristic of these periods, but they don't happen very much, you can run into issues when you're trying to look at statistics for them. The S&P, again, these are very rare periods. The S&P has only had drawdowns worse than 20%, about 4 times since 2000. But just because a flood happens once in a millennia doesn't mean you shouldn't try to prepare for it. So what tools or methods are there to help investors potentially cope with these periods of ultra-rare extreme price volatility? So before I get into it and the model that I want to talk about, I want to say that it's always important to note that there are no real metrics or management strategies that can completely replace appropriate position sizing. That is extremely important no matter what type of model you're using or what type of metric you're using. But if the market does in fact shift between different volatility states, there are methods that may be able to detect those shifts in real time to potentially help investors respond to them a little bit more quickly. And one of the most popular methods for this is the hidden Markov model. So Markov models are a type of state models that describe probabilistic systems that follow a Markov process. And what we mean by a Markov process is simply a memoryless stochastic process, where the probability of transitioning between states depends only on the current state of the system. So for example, a Markov model might be used to detect that an engine in a car has transitioned from an operational state to an in need of repair state. So the appropriate type of Markov model to use really depends on how much system information is observable and whether the system can be sort of modified based on those observations. So for example, the engine in our car, can the functionality of that engine be measured directly, or do we need to infer the state of the engine based on some other variables such as temperature? And then can a part of the car modify the engine or other state variables depending on that indicator? So those are kind of the variables that we're going to be looking at when we decide what model to apply to our hidden state problem in the stock market. So typically what would be used for this type of problem are hidden Markov models. Those are used for autonomous systems or systems that cannot be modified by the agent. We're going to assume that no single agent is going to be able to modify the market with partially observable Markov processes. So what that basically means is that the hidden state variables must be inferred by some dependent observable process. So hidden Markov models would then be appropriate for volatility regime detection because state variables or different volatility regimes are not directly observable, but rather we have to infer them from some other observable dependent variable such as daily returns is what we're going to use in this case. So if we want to describe this in mathematical terms, just getting into the model a little bit, if we assume at some time t that a process can be described by some hidden Markov state zt, which again cannot be directly observed, but rather produces an observation x of t, then since the underlying process is Markovian, another assumption that we're going to make, the current state of the system zt depends only on the previous state of the system zt minus 1 and not the rest of the history. And here we can see a nice little graphic of our different Markovian variables, our z of t history, and then the observable process that it produces, x sub t. So the model for the system is defined by the following elements. So first of all, we need the different possible states for our hidden variable zt. So for volatility states, that might be low and high volatility, for example. We also need the sequence of observations produced by the system, which in our case is going to be returns. We need the initial state distribution of the system, which basically describes the probability of the state beginning or the system beginning in a certain state. And then we also need a transition model, which describes the probability of the state transitioning between different Markov states. So we also finally need the observation model, describing the probability of making an observation x sub t for a given Markov state. And when we combine all of these different components, we can yield the joint distribution for any given sequence of hidden states and corresponding observation observation states, which again are going to be returns in this case, and then our Markov states are going to be volatility states. So again, for our purposes, returns values are going to be our observations, and then that's going to correspond to one of n possible volatility states. I'll get into what n is going to be in a minute, but for example, for n equals 3, that could be low, medium, and high volatility states. And we're going to make the assumption that each of those states is normally distributed. So there's some different algorithms that you can use to actually train the model, the Baum-Welch algorithm, for example, and that's specifically to estimate the initial state probabilities, transition probabilities, and observation probabilities of our Markov model. And then you would need another algorithm, such as the Viterbi algorithm, to determine the most likely sequence of hidden states for the corresponding observations. But from this joint probability distribution, we can get an output sequence, which can be used for tasks such as identifying patterns in our data, or predicting future states, or identifying similarities within our sequence of data. So what I want to do is a very simple backtest to sort of investigate the potential of using this model to detect and respond to high volatility market states. And I have to emphasize before I get into it that this is a very simple backtest that we're more so using for a proof of concept, just to see if some of the concepts that we've discussed today, such as volatility clustering and such as volatility states, can be maybe used for practical strategy for something that's a little bit more sophisticated. Okay, so our very simple backtest is going to use the following assumptions. So we're going to assume that the market transitions between two possible volatility states, so n equals 2, which is really going to correspond to a high and a low volatility regime. Our second assumption is going to be that high volatility moves tend to cluster in very close proximity to one another. And we're going to use these two assumptions to make a very, very, again, basic strategy, which is that we're going to pull out of SPY for tomorrow if there's a high volatility indicator today, and otherwise we're going to remain in SPY. Again, to see if this model can potentially be used alongside our assumptions to maybe reduce exposure to certain high volatility conditions. And we're going to look at SPY from 2000 to present with training, validation, and testing sets. So over here, we can see the Markov states from our training sets, which is from 2000 to 2017. We can see over here that we're immediately seeing like volatility clustering in the different states, which is already a good sign. And we can see that the sort of like high volatility states tend to correspond to significant drawdowns, most notably periods of the dot-com bubble popping, but then also 2008. So this is already looking like a good sign, but then we can move on to testing the strategy live in our validation and testing state phases. So the first thing that we noticed during our validation period, or validation testing period, is that the strategy actually seems to do pretty well. And this is normally the period when we would sort of evaluate the model to determine if we should make any modifications before moving on to the testing period. And what we can see here, our first observation, is that the strategy is definitely not foolproof. We are still subject to pretty significant drawdowns, notably in 2018. But there are periods of market volatility that the strategy avoids, most notably the 2020 sell-off, which is extreme volatility. So when we look at a comparison of the distributions for our HMM strategy and then SPY, the HMM strategy actually had significantly less returns volatility compared to what we were looking at. Significantly, like about half actually, which is pretty notable. So we're not going to make any significant changes to the strategy because it's a proof of concept. We're just going to go on to testing. And what we see during the testing period is that the HMM strategy, again, did have lower daily returns volatility compared to SPY, our benchmark. We also see that the HMM strategy returned roughly half of what the market did during that time, which is not terribly surprising because the strategy tends to avoid market volatility overall, including the rallies, the very volatile rallies of 2022. So what can we conclude from this study? So during testing and validation, there was pretty clear evidence of volatility clustering between the two possible volatility states. But it's important to note that that was pretty arbitrarily chosen in terms of using 2. There might be 3, there might be 4, and there might be more strategic choices that we can look at when we sort of move forward with testing other strategies. The second observation is that there was evidence that trading more defensively in response to a high volatility indicator may reduce exposure to volatility in certain cases. But it's very clear from this simple strategy that it needs to be optimized for performance and risk management before it would ever be implemented. But it's still promising enough to potentially revisit the strategy in the future. In terms of like what that might look like, if we wanted to improve the strategy, it really depends on the goals of the investor. It's a very personalized process. But for example, it was an arbitrary choice to pull out SPY for one day after we got the high volatility state indicator. Pulling out for a longer period of time might be more strategic, or potentially, transitioning to gold or bonds or some other defensive asset. There are also a number of advantages to selling premium during high volatility states. So for short premium sellers, high volatility states don't necessarily want to be avoided entirely, but that strategy specifically may incur very large losses when the market transitions from a low volatility state to a high volatility state, especially if that's unexpected. So in that case, the HMM indicator could potentially be used in conjunction with IVR or IVP or the VIX directly to potentially identify more strategic times to sell premium. But in conclusion, there is strong evidence from many of the different slides that we looked at today that the market may shift between different volatility states, where each volatility state has unique properties and may exist for a sustained period of time. State models, such as hidden Markov models, may be able to identify these different states and detect transitions between them in real time. But to use hidden Markov models for practical trading, it's a very good practice to pair them with other risk management strategies and additional metrics, some of which I've talked about today. So thank you guys very much for watching. I hope you guys learned something. Peace.
Dr. Data. Dare I say he's my favorite? He's the man behind the cherry picks each week that contain data-driven trade ideas straight into your inbox. He's my go-to guy in the office, and he comes in every day wearing a tie, Birkenstocks. He would be rocking a baller silver chain if it were socially acceptable. He is going to be talking about brains over bots at tastylive. But let me tell you a little bit about him first. His real name is Michael Reckentine, and just like his favorite superhero, Superman, he too has an alias. We all know him as Dr. Data, and his real superpower is guiding us through everything AI. Without further ado, let me introduce the real Superman at tastylive, Dr. Data.
Welcome, everyone. I'm Mike Reckentine, also known as Dr. Data. I'm a PhD in machine learning from the University of Iowa, and I've been involved in trading and investing for close to 25 years. Today, I want to share with you some insights into our approach at tastylive and focus on the concept of brains over bots. So the role of bots within trading is that, of course, machines are really good at speed. They've been involved in the market-making side of the business for 20-plus years. They're very good at executing trades very quickly. They're good at outlier detection, spotting fraud, spotting when a highly correlated stock has gone down perhaps faster than another and looking for opportunity there. Getting even more complicated with an options trading, they can be really good as far as determining where a price has gone outside of perhaps its theoretical, based on the option chains and the expirations that are before and after that particular strike, and so then you can determine what's maybe priced higher or priced lower. These are all examples of where bots are really good at doing things. But bots, they're not oracles. They can't tell you the future. They can assist you with perhaps the probabilities, and when those probabilities are slightly to your advantage or disadvantage, but they can't tell you what you should do, at least not yet. They struggle with making these projections and understanding individual goals. They can't account for risk tolerances. So I'm going to tell you how we approach this at tastylive, and then some of the tools that you can use to help with your trading. At tastylive, we use automation to handle repetitive type tasks, generate titles, generate summaries, provide talking points, things that we found it very difficult to get people to do. Very mundane things at times, repetitive type tasks, things that are very manual. So one of our key tools in automation is called Look Back. And Look Back allows us to automate the analysis of complicated strategies that we use for our shows on tastylive. We used to take about 16 hours as a group to come out with a study, back-tested results of a strategy for tastylive in our segments. This tool, though, automates this process and just brings it down to seconds. It allows us to make more informed decisions. It allows us to then present this information to the user. And we built this, at least initially, I built this internally for ourselves within the research team, but now we're offering it. We've come out with several different additions to it, and we've really sped up the speed on this, and it's now available for you to be able to test out yourself different strategies. So if you want to be able to test out how a covered call works, or perhaps how a short put works and how that compares to another strategy, this is something that computers do really a good job at. Then it's up to you to make the decision. So it is automation. It's removing the mundane, it's removing the boring stuff, but it's keeping you as the driver because you know yourself better than a bot. When examining the Look Back tool, you determine how much risk you want to take. You look at the performance of the option strategy, such as short put as a replacement for buying stock, for example, and you can see how well it's performed. This tool will help present you with different scenarios and allow you the ability to see how well these strategies would perform. And then it's up to you to be able to examine the outcome and determine whether or not you'd want to do the same thing. So another tool that we've come out with is Ask tastylive, and this is a bot. This is a virtual assistant that allows traders and allows users to ask trading type questions, questions that they might be afraid to ask or questions that they would ask support. This allows you to be able to ask the questions and then get back a suitable answer along with suitable videos for that particular topic. And this is based on 13 years of content that we've created within tastylive. It's built on up to 10 hours a day worth of content. That makes up for a lot of content that we've built and put in this bot. You simply type in your question, and then we search the articles and the content and the videos to find the ones that have the closest proximity to what the question is. And it's up to you to find then what you want based on the responses. It tells you where to point your eyes. On the back end, you know how we've done this. We built this all in-house, and we're using open source software for doing this and resources for doing this. It's really become like a data acquisition problem for us. We've embedded our videos. We've put all this information within vector databases, and then we search the questions for videos and content that is closest to the proximity of those particular vectors, and then we output it to large language models with the answer for you. I encourage everyone to experiment with these tools. Sign up for Look Back at tastylive.com as a way of analyzing your options strategies and positions and see how well these strategies would have worked in the past, and then it's up to you to determine whether or not you want to take that analysis into play with trading your positions. And then also I encourage everyone to use Ask tastylive, the bot, as a way of asking questions related to trading and life, and to get answers from the team here at tastylive and all the thousands of hours worth of content that we use to build this bot with. And then let these tools all make your life a little bit easier and to automate some of the boring stuff. Thank you.
Jacob Perlman, the original. He's the OG geek at tastylive. He's the godfather of this tour and the reason behind the name. I first met Jacob 13 years ago when he was on a show called Sneak and the Geek. The premise of the show was Sneak, the host, was asking people questions about anything, and if they didn't know the answer, they would turn Jacob, the original geek, around in his chair and he would answer it. Anything. That's how smart he is. I once heard this analogy, and I thought it was perfect about Jacob. He's teaching tastylive to be grandmasters at chess on a high level when the rest of the world is still playing checkers. He's raising us all up to his level. Very random fact about this genius is that he never misses a Burning Man. Awesome, right? Ladies and gentlemen, you're gonna have to watch this 10 to 15 times before it all sinks in. Jacob Perlman discussing the Black-Scholes as a lens.
Hello, everyone. I'm Jacob Perlman, and today I want to talk to you about using the Black-Scholes model as a lens to view the market and how that can help us demystify some of the possible futures that we all have to deal with. So, to start off, we're going to need to set up what the Black-Scholes model is, what it isn't, and how we got there. In the Black-Scholes model, it starts at trying to describe how prices of underlyings evolve over time. And it relies on a couple of observations and one bold assumption in order to describe this. The observations are, firstly, the weak efficient market hypothesis, which says that all price information is entirely useless except for the current price. And what that means is that if you're looking at price changes over disjoint time intervals, right, up to how the prices have changed from here to here and how the prices have changed from here to here are independent. This change can't depend on this change. It can only depend on this one point. That independence is key. And then the next thing we want to do is we want to invoke the central limit theorem. The central limit theorem applies to sums of independent, identically distributed random variables. And it says that they, as you get more and more of them, turn into a normal distribution. Unfortunately, when we're thinking about returns, the later price divided by the initial price, those don't sum. That's not how that works. But logarithm gives us like a nice little algebraic trick where now all of a sudden log returns do sum because log of a product is the sum of the logs. So from the prices evolving as geometric Brownian motions, we can derive closed form formulas for fair value prices of options, both calls and puts. And the formula looks kind of messy, but it is just a little pile of variables. It's totally tractable, totally computable. And it mostly derives only on market observables. It derives from the price of the underlying, the strike price on the option, the time remaining till expiration on the option, the risk-free rate of return, which will approximate with a long-term bond rate, and then this one other quantity, this sigma, or sigma squared. And there's a couple ways to think about it. It came from the driving force behind the Brownian motion that we had. Brownian motions have two parameters. They have a drift parameter, which says how they're moving around over time in a driftly way, and an infinitesimal variation, which says how fast their wiggling is. And so sigma squared here is the infinitesimal variation of the log return Brownian motion. And this makes the sigma squared not directly observable, but prices are strictly increasing in sigma squared. So the whole thing can be inverted, and we can go from current market prices to derive the implied volatility, which is the standard deviation of annualized log returns, which under the Black-Scholes model would make the current option prices correct. That's implied volatility. And this was great. From the time when Black-Scholes published their model until 1987, almost every single option that was traded at almost exactly its Black-Scholes theoretical value. It had done such a perfect job of describing the market. Except there's no such thing as a perfect model for the market. In physics, I can write down Newton's equations of motion, which would describe how a ball struck with an initial velocity at an initial angle in a given gravitational field will move forwards and upwards and downwards. And then I can run the experiment. I hit the ball, I look at it, it flies. If it matches my model, great, good evidence for my model. If it doesn't, I throw the model away. Social sciences are well familiar with a problem known as the observer paradox, where their subjects, because they're people, change their behavior when they know they're being studied. And so it's very hard to get a laboratory type setting for social sciences. And financial math has an even worse thing. Because all of a sudden in financial math, why were all these options trading at exactly their Black-Scholes theoretical value? Well, because the traders were using the Black-Scholes model to price the options. That was how they were determining how much they were willing to buy and sell them for. And in that way, right, it's as if I wrote down my formula for how the ball was going to fly, and then the ball read my formula and did its best to fly that way. It doesn't mean that my formula described how balls fly. It means that the ball looked at my model. In the same way, the traders looked at the Black-Scholes model and used this to price options and ushered in this golden age of trading options that lasted until 1987, when there was a massive crash and everyone realized that maybe they had put a little bit too much faith in this model. And in fact, because of this describer paradox, there's never going to be a perfect financial math model. It can't be done. They will always feed back on themselves and influence their own outputs. Ever since 1987, all of a sudden, each individual option has its own implied volatility. We can always invert these for each of the prices. And all of a sudden, they don't give the same volatility. As we move strikes away from the money, the implied volatilities go up. As we move them out in time, the implied volatilities go down. Typically, there are exceptions. And as a result, we don't have the volatility of the underlying, the infinitesimal variation of the Brownian motion driving the log returns. Instead, we have a volatility surface describing the implied volatilities at every strike and expiration. And these are not compatible values. So it shows that the market does no longer believe in the Black-Scholes model. It isn't true. And the market knows this and prices its options based on supply and demand in a way that represents what it actually thinks the underlyings are going to evolve like. So if it's not true, what is the value of the Black-Scholes model? Why am I talking to you about it if it's been known to be wrong for 37 years? Well, it's because it's wrong, but it's a much better frame of reference than just raw looking at the prices of the options. And so I'm going to get there by an analogy. Long ago, humans wanted to describe the motions of the planets and stars in the sky. And they tried to write down formulas for this. And the ancient Greeks did. And they could map out where Mars is going to be every day of the year. But it's a very complicated formula because over the course of a year, sometimes Mars is closer to Earth, sometimes it's further away, sometimes it's over there, sometimes it's over here. It moves around in these like loop-de-loops relative to Earth. And that's complicated. The formulas were hard to follow. It was very difficult to compute where Mars was going to be, even though it could be done. And this went on until Copernicus, which is much later, who pointed out that if instead of using the Earth as the center and thinking about how Mars moved relative to Earth, we viewed the sun as the center, well then Earth, Mars, Jupiter, every planet seemed to go in almost perfectly stable ellipses around the sun. And now the formula for how Mars was moving was no longer this complicated loop-de-loop thing. It was just a very simple ellipse. And where was Earth? Also a simple ellipse. And if you want to know the relative positions, you just compute both ellipses. And in the same way, the Black-Scholes model isn't a description of the market in the same way that the position of the sun isn't a description of the position of Mars. But it is an easier way to view where it's coming from. Why do we want to use the Black-Scholes market as our sun, as the center of our universe? Because by thinking about how the current prices deviate from a Black-Scholes model, we have a much more direct way of looking at how we think future prices are going to be. And part of that's because in the Black-Scholes model, log returns going forward are normally distributed. And because of the central limit theorem, the normal distribution is everywhere in life. Anytime anything is made of lots of little pieces, you can probably expect it to be normally distributed. And so because of that, people, just almost everyone, already have a pretty good intuition about the normal distribution. You have an idea about what's within one standard deviation, what's within two standard deviations, how weird is it to be how far away. And by applying that logic, we can now look at the implied volatility surface and see that while the market says that it's not normally distributed, it's easier to think about, rather than just the raw distribution implied by prices, just how that distribution differs from a normal distribution. The fact that the implied volatility surface goes up as you move away from the spot price means that those large moves, those far out of the money options, are going to be crossed more often than they would under Black-Scholes model, which means the tails of the distribution of future prices is just fatter than the normal distribution. But that's an easier way to think about how fat they are by just scaling them from the normal distribution than trying to look at it directly. In the same way, we can look at the skew, right? Typically, for most underlyings, we find that the puts out of the money are of a higher implied volatility than the calls out of the money. And what this means is that relative to the normal distribution, we're having a significantly fatter tail on the downside, and then there's a narrower tail to the upside. But then because of the efficient market hypothesis saying that current prices are correct, we find that we must have high probability of having small up moves balanced by a low probability of having big down moves, and that is the sort of key reading from the implied volatility surface. And it just gives us an easier way to think about it. Rather than trying to read the prices of the options directly, we can look at the implied volatility surface and then adjust our position based on that. In the same way that knowing where the Mars is relative to the Earth is complicated, but knowing where Mars is relative to the sun is a relatively straightforward thing to look at. Knowing how the market is on its own terms would be almost impossible. But knowing how the market is different from the Black-Scholes model gives us a much more direct line at understanding it. So the Black-Scholes model is not an accurate description of underlying price dynamics. The current market prices for options roundly refute it, as can be seen in the implied volatility surface. But there will never be a perfect financial mathematical model because any mathematical model for financial derivatives will influence the prices of financial derivatives as people want to trade off of the model. So instead of thinking of it as it's intended to describe how the market actually is, it serves us as a baseline. And we can think about how the market orbits around the Black-Scholes model, rather than trying to think about as loop-de-loops and weirdnesses and confusions of their own. If we subtract out the Black-Scholes model and just look at the differences in reality to the Black-Scholes model, everything becomes a lot more simple and tractable. Thank you.
That's a wrap on Geeks 2024. Shock and awe in what I saw on this stage is an understatement, ladies and gentlemen. This is something that I will watch probably 20 times over and will to my children when I'm done. So thank you very much for joining us. And go out there and remember to trade small, trade often, laugh with us, learn with us, and watch the geeks.